The internet keeps predicting a crash. Recession headlines, debt at record highs, geopolitical tension, AI bubbles. So, why hasn't the market collapsed? Hey everyone, today we're going to audibly and visually break it down for you. No conspiracy, no hype, just how the system actually works. The market isn't the economy. When grocery prices go up, when rent doubles, when unemployment spikes, stocks can still go up. The S&P 500 isn't a reflection of the average worker's life. It's dominated by giants like Apple, Microsoft, and Nvidia, the AI chip manufacturer whose workforce is reportedly made up almost entirely of millionaires. No, I'm not making this up. 75% of Nvidia's employees became millionaires in mid-2025 due to the company's explosive growth in the AI sector. This shows just how powerful owning stocks can be. It's not just about working 8 hours every day, clock out and be done with it. It's about ownership. When people say the economy is bad, they're usually talking about inflation, rent, grocery bills, layoffs, not the stock market, which mostly reflects large corporations. The biggest companies in the S&P 500, like Apple, Microsoft, and Nvidia, make money globally. Even if U.S. consumers struggle, these companies earn international revenue, cloud contracts, AI infrastructure deals, enterprise subscriptions. The stock market can rise while people feel broke. The Federal Reserve, like a car, is the real shock absorber. When markets wobble, the Fed can lower interest rates, inject liquidity, signal future support, calm investors with forward guidance. Since 2008, markets have learned something powerful. When things get bad enough, intervention comes. That expectation alone stabilizes markets. Investors call it the Fed put, essentially an implicit, unconfirmed safety net. Passive investments changed everything. Most people don't actively pick stocks anymore. Money automatically flows into 401ks, index funds, or ETFs. Every paycheck sends capital into the market regardless of scary headlines. Funds like those tracking the S&P 500 or the NASDAQ buy stocks mechanically. That creates constant buying pressure. In past decades, panic selling caused cascades. Today, automatic investing acts like a slow, steady inflow of fuel. When giants like Amazon rally, they can offset weakness in hundreds of smaller stocks. The index looks strong, even if many companies are quietly struggling. Markets don't crash because something is overvalued. As long as banks are lending, capital is being poured into funds, central banks remain responsive, the system keeps working. Overvaluation alone isn't enough. Markets run on expectations. And one of the most powerful expectations right now is AI, artificial intelligence. When companies highlight AI initiatives, investors interpret that as future productivity gains. Investors aren't just pricing current earnings. They're pricing an inevitable technological shift. Speaking of companies, another overlooked factor is corporate buybacks, share repurchases. After paying for operations, debt, and investments, some companies end up with more cash than they immediately need. When corporations generate large profits, they often buy back their own stock. This pushes their earnings per share higher, even if profits remain the same. This often makes the stock look more attractive to investors. Those shares are effectively taken out of circulation. Fewer shares means each remaining share represents a slightly larger ownership stake in the company. Even if retail investors hesitate, corporations themselves become buyers. It's another layer of support beneath the market. Companies prefer buybacks over dividends because they can be more flexible, are sometimes more tax efficient for shareholders, and signal management's confidence in the company's future. Dividends are taxed immediately as income for shareholders. Buybacks, however, often allow shareholders to only pay capital gains tax when they sell their shares, which can be lower than dividend tax rates. This makes buybacks a more tax-efficient way to return cash to investors. Management buying back stock can signal, "We believe our shares are undervalued." This can influence investor perception and potentially lift the stock price up. In the past few decades, companies have faced pressure to deliver short-term stock performance from shareholders and analysts. Buybacks are an easy way to meet quarterly targets without actually growing the business. This is why some critics, like economist William Lazanick and BlackRock CEO Larry Fink, argue that buybacks prioritize short-term stock price gains over long-term investment. In recent years, buybacks have reached historic levels. In the 1980s, the same year Pac-Man was born, the SEC relaxed rules and made buybacks easier. Tax policies and financial reporting rules also favor buybacks in certain cases, encouraging corporations to use them over other methods. Buybacks aren't inherently bad. They can be smart if the stock is undervalued. But when companies do them just to boost earnings per share, just to inflate stock prices, it can lead to what researchers like to call short-termism or quarterly capitalism, where focus shifts from real growth to financial engineering. If you have some money in a mutual fund, 401k, or ETF that holds stocks, buybacks can boost those funds' values.
Okay, so forget Qatar capitalism or whatever you just called it. We should all encourage companies to do more stock buybacks so we could all retire at 30.
Except if a company over-prioritizes buyback short-term, it can take money away from long-term opportunities or resources for workers. In other words, jobs, wages. Money used for buybacks is money not spent on hiring, research and development, or expansion. Expansion into other states means even more jobs. You get the gist. So, why don't they want you to know? No secret darkroom, no secret cabal, no Illuminati, just this. The market isn't built to protect you. It's built to protect asset prices. It favors capital owners over wage earners. It can stay irrational longer than most people can stay financially stable. Waiting for the big crash can cost you more than just participating in it now.